Hi, this is Jim Sackman, your Focal Point Business Coach, and again, this is another of the Success Friday videos. Our topic now is financing your business, and this particular video is about debt or equity. And I want to start at the very beginning, making sure everybody understands debt or equity. And debt is pretty familiar to most people because in the consumer world, we have credit cards, we have auto loans, student loans, home mortgages, things that are used to buy a product or service up front and you pay it off over time. And the same thing's true in the business world. You get a loan of some type, you're going to pay back the principal plus some interest to the lender. And there's many forms of this in the business world as well, things like corporate bonds, business loans, or lines of credit. Each of these vehicles has a different place in the universe of debt, depending on the size and where the company is in its life cycle. The other thing you'll hear about when you talk about a debt is underwriting, and that is the process by which people evaluate whether the loan you're asking for meets their standards for lending, because people try to manage their risk and want to make sure they get paid back, and so different kinds of loans have different kind of underwriting guidelines. Now, the other form of financing is equity, and that's pretty much selling a portion of your business to one or more people. Now, many of us are really aware of this through the stock market, where what are called public companies sell portions of themselves on a daily basis, and actually people transact those portions of the companies between themselves outside of the company, and that's the public stock market. So the NASDAQ, NYNEX, whatever stock exchange the company is listed on. There are also private companies which have stock, and if you make a corporation, you'll have stock, and you sell it privately to people outside of the stock markets on a one-on-one basis. And small companies like that can generally get one or more investors by selling stock to them, depending on the kinds of condition the business is in. So the question is the difference in how you get paid back. And I want to give an example of what's the difference between these so that we've got an understanding of these two basic vehicles, and there are some middle grounds that we're going to talk about over time as well. For a loan, for example, you might have a company that takes in $500,000 and pays off that loan with interest in the future. If a company gets $500,000 in equity, it's actually worth $500,000 more. But now there's a liability called shareholders' equity on the balance sheet, which balances that cash that get brought into the company. Now, the way that these really differ in the long term is the way that people get their returns. If you get debt, essentially it's fixed in base the principal plus the interest, and it's upset up front. For equity, it can be much more complex. If you're not going to be able to sell that stock in a liquid manner on a public market, then how is the investor going to get his principal back out of the money he gave you, and how are you going to make him a profit over time? And those are the questions that they're going to want to get answered, and in some ways it means that equity can actually be more expensive than debt. So there you go. That's a very basic introduction to debt and equity, and this is Jim Sackman from Focal Point. Change your business, change your life, and have a great day.